Hi friends, myself CA Yashveer Singh. We are making video series on business structure options in India. We have already come up with introduction video and part 1. Today we are doing part 2. So let's start. Okay. So Indian business structures. Today we will be discussing definition, key features of these structures, advantages, limitations and best use cases. Okay, so let's start. Definition, as already we have gone through one time, I will just take you one more time. A sole proprietorship is a business owned and operated by single individual, and legally the business and the owner are the same. There is no separate legal entity. Already we have discussed in last video also that there is no separate legal entity. Business owner and firm itself are one and the same thing. For a partnership firm, a partnership is a business owned by two or more persons who agrees to share profit and liabilities. So two people coming together, two or more, and coming together and who agrees between them to share the profits and liabilities, and it is governed by Partnership Act 1932. Limited liability, an LLP hybrid structure, is a hybrid structure combining the benefits of partnership, a normal partnership firm, that is flexibility, and company limited liability, and option of company's limited liability. So it's a combination of both normal partnership firm and private limited. So from normal partnership it has taken the flexibility of adding the partners and all that, and from private limited it has taken the limited liability concept. It is introduced by LLP Act 2008, and private limited company is a registered company under Companies Act with the limited liability and separate legal entity legal existence, and highly regulated but most robust also at the same time. So private limited is a separate legal entity, LLP is a separate legal entity. Only partnership firm, if it is registered, then it is a separate legal entity, otherwise it is not a separate legal entity. Okay, so what are the key features of proprietorship firm? So legal entity, not a distinct from owner, already discussed. Formation, so formation, no registration required with MCA or anything like that, just simply take a local registration like GST, Shop and Establishment Act, anything will suffice. And then taxation, the tax does as an individual slab rates, no corporate tax. So here in the proprietorship firm, the taxation will happen on the profits based on the slab rates. Now next, normal partnership firm taxed at a flat rate of 30% surcharge and cess. So here we have a benefit of slab rate, but here it is flat 30%. Even for the LLP also 30% flat profits are there, tax at the rate of 30% on profits plus cess and health and education cess and surcharge. For a private limited company, maximally we have already discussed 3 to 4 rates in the previous video, just for reference. So most of the people will use 22% plus surcharge plus health and education cess. For new manufacturing companies, the rate is 15% tax rate. Okay, but here if you see, next we will come to tax slab. Already we have discussed. For a partnership firm, it's not a separate unless registered. As I told you, if it is registered, then it is a separate legal entity. Formation, it will happen via partnership deed, preferably registered with, so it is advised that you register your partnership with registrar, so your entity becomes separate also. And flat tax rate, already we have discussed. Again here LLP is a separate legal entity, partners liability is limited. Limited means partners liability limited means the partner's asset cannot be used to pay off the business liabilities. Only the liability is limited up to the extent the partners have committed for the capital, that's all. Now for the key features of a private limited company, distinct from its shareholders and directors. So it's a distinct entity from its shareholders and directors. Okay, shareholder, maximum shareholder 2 to 200, and director minimum 2 is required. Okay, only thing is that in private limited company there are high compliances, ROC compliance mandatory, statutory audit is mandatory, conducting board meeting is mandatory, annual general meeting conducting is mandatory. So compliances are more in ROC, which also is a beneficial, which gives a more transparency for a private limited company also. Okay, let's talk about advantages. So proprietorship firm, it's a simple to incorporate and cost effective, because there is no registration as such separately taken, only the tax registrations are taken. So it's a simple as well as cost effective, easiest to start and close, minimal paperwork, complete control owner complete control. Owner makes all the decisions and no interference. Lower compliance, no mandatory audits, board meetings, MCA. There is nothing, no compliance as such. Tax flexibility. If income is below tax limit, no tax marginal rate benefit will apply. Okay. Next. For a partnership firm, what are the advantages? It is easy of formation. No MCA registration needed, only partnership deed. If two people come together and form a partnership deed and get it registered if required, otherwise not required. If not also, then also fine. Apply for PAN and start your business. Shared resources and skills. Partner brings complementary expertise and capital. Flexibility. Internal arrangements, profit sharing and roles and are customizable. So internal, so partnership, within the partnership with the mutual consent, the partners can make rules that what will be the roles for each other, and what ratio the profits will be shared, what will be the capital contribution ratio, all these things. So it provides a flexibility because only two people's mutual consent is required, or two or more partners coming together, their mutual consent is required. Lower compliance, so there is no requirement of annual filings like MCA, board meeting, AGM and all those things. So lower compliances are there. So this is again one advantage for this. Flexibility is one more advantage. Share resources and skills and ease of formation. Now let's talk about LLP advantage is that limited liability. Personal assets are protected. So personal assets of partners are protected. They cannot be used to pay off the liabilities. Separate legal entity, as we all know, LLP is having separate legal entity. LLP can enter into contracts, sue, own property. So LLP can buy property, can sue other people's, and can also enter into contracts in its own name. Operational flexibility, no stringent corporate structure like board meeting and all, like private limited, there is nothing like that. So operational flexibility is the perpetual succession. So partners may come and go, but the LLP will keep on continuing. Okay. Moderate compliances. So moderate compliances, annual ROC filings are there, and audit only if the turnover is more than 40 lakh rupee or contribution is more than 25 lakh rupee, then only the audit applicability will come. Okay. Next, for the private limited company, again it's a separate legal entity, can open an account, can be issued independently in its own name. Preferred by investors. See, private limited is preferred by the investors because easy to issue equity capital, ESOPs, convertible notes. So if you are starting a private limited and you want to take an investment, simply by giving the shares you can take the money from the investors, or for retaining the employees you can issue ESOPs. So very easy to give a stake in the company, and which attracts the investors, which attracts employees. It helps retaining employees. So this structure is flexible in sharing the stake in the company. Okay. Next, global credibility, suitable for international clients, contract and expansion. So global credibility comes why? Because audit is mandatory, so many disclosures are there, all the reports can be downloaded from MCA. So credibility is there because transparency is there. Okay. Then scalability, easily adds shareholder, raises venture capital funds and angel fundings. Okay. Let's discuss next. So limitations. Now let's talk about, we have spoken about advantages. Now let's speak about limitations. For a proprietorship firm, the main problem is that the liability is unlimited. Owner's personal assets are at risk for a business debts. If any business debt is unable to pay from the business, then the personal assets also can be used of proprietor to pay off the liability. No perpetual succession. Business ceases to exist on death of owner. Okay. Limited funding option, cannot raise equity, bank may require collateral. So if you go for a loan, and if you are running a business in proprietorship, the bank may ask that you provide a collateral towards this loan, so that if you are not able to pay, then we can recover from the collateral kept. But in private limited company and all that, collateral will not be required. Okay. No brand perception, not seen as a credible, scalable by investors also. Okay. No brand perception. So being a proprietor, you can not share your stake and all. Other person coming as an investor, you cannot commit make him part of the business, stakeholder in the business. So that's why it's no brand perception. Okay. Partnership firm, again it's unlimited liability. Partners are personally liable, risk extends to personal assets also. No legal shield, cannot sue and be sued as a separate person. So whenever case is filed for a private partnership firm, the partner's name is brought into the case. As well as when partnership firm wants to file a case towards the third party, then in that case also the partnership, in the name of partnership, complaint will not be filed. It will be filed together with the name of the partners. Okay. So no legal shield is there. Limited, so it drags the name of the partners. Okay, limited capital raising, cannot issue shares or raise VC funding. So it only has to keep on changing the partnership deed, adding the partners, and then only it is possible to get the funding. So these structures are not liked by the venture capitalist or angel funds and all those things. Okay, so limited capital raising options are there. Instability, ends on death or retirement of any partner. If any partner retires or any partner is deceased, then the partnership firm gets closed there only until reconstituted. Okay, so condition is there, if you reconstitute, it can continue. Okay, so every time this is not possible because partners sometimes they do not agree, because let's say some active partner was there who is looking after the business. If he dies, then other partners will step back, they will not continue the business. Okay, now let's talk about LLP. So for limitations of LLP, no equity investment, cannot issue shares, no, not preferred by VC and Ps, private equity, because again that you cannot keep ending the shareholders partners and keep amending a partnership deed and every time going for registration and all. So it is not liked by the not preferred by the VCs and Ps. Rigid governance in practice, complex dispute resolution if not well drafted. If you have not well drafted your LLP agreement, then the dispute resolution can be very complex. So if you don't mention everything, that what scenario can be there and what will be the there is a mutual consent between the existing share partners in the LLP agreement. If it is not written clear, then it can lead to too many disputes, as well as the resolution, it will also not come so easy. Higher tax rates, 30% tax rate is again a limitation, whereas the private limited is having option of 15%, 22%. Those kind of options are there. Public perception, less prestigious than private limited for some industries. Okay, so because private limited, more audit is mandatory, more compliances, more disclosures are there, that's why it's less prestigious than private limited. Public perception. Okay, now private limited, let's talk about private limited limitations. Higher compliance burden, because annual filings are there, tax audits are there, directors meetings, AGMs. So compliance are surely more there in the private limited. If your business do not require that kind of structure, you can avoid, because if you avoid that kind of structure, then you can avoid so many compliances burdens. Okay, next, complex setups requires DIN, DSE, MOA, AOA, registration with the MCA, all those things, as I explained in the previous video. All these things are required if you want to start a private limited company, which is not applicable for other structures. Then higher cost, CA and CS assistance needed regularly, compliance costs are ongoing. So because we have to do these compliances and this can be done by experts like CA and CS, so the higher cost is there, because we have to keep taking the services of CAs, and so for that they will build their professional services also. Public disclosures, financials available to the public. No, if you are into business where you feel like that the disclosing your financial data can lead to you competitors coming to know how much business you are doing, and that can reveal your business secrets or it can hamper you, then you should avoid making a private limited, because from private limited, once you file your annual filings, everybody can download the reports and get to know that how much profit you have made that year and what is the turnover you are achieving. All those things are very transparent and anybody can have access to. So if your business is having secrets like this and do not want to disclose the financial details of your business, then avoid doing the private limited. So it's a limitation. Okay. Similarly, for a partnership firm or proprietorship firm, people will not be able to get the data so easily. In market, your data will not go out so easily. Okay, now let's talk about best use cases. So for a proprietorship firm, if you are having a local retail shop, freelance, home-based businesses, so these kind of businesses, proprietorship firm will suit. Okay, because here there is no requirement of more capital, ESOPs, all those things are not required in these cases. So proprietorship is better. Testing a business idea before scaling. So if you have a business idea but you are not sure that whether it will work or not, so instead of opening a private limited, I will suggest that go for a proprietorship, test that model for 6 months to 1 year. If you find that okay, it's working out, then shift to private limited company. Okay, until you are sure that this will click or not. Okay. Then service-based consultants. So those people who are into service-based consultants, they can early stage, if they are in, they can start from proprietorship if everything is fine, then they can later on move to partnership private limited kind of setup. Okay, now let's talk about partnership firm. Best use cases. Who should open the partnership firm? So small family owned businesses. Mostly the partnerships you will find in the market for mostly people will form partnership who are into family business and all. So there are less chances of dispute, no need of much regulations. Internally discussion can happen and people can come on a mutual understanding. So that's why the family owned businesses like mother father or son father, mother son, like that way, uncle and son, like uncle and his cousin brother, like those kind of things. If that kind of a business is there and family owned is there, then you can go for a normal partnership firm, because the compliances are less and disclosures are not there. Data disclosure is not so stringent here, so better you go for this kind of business part. And this is the practical aspect also, people are going for partnership firms only. Traders who are into business of trading, those who are into wholesalers, small manufacturers, all these people, for them also partnership firm is best, because traders and all, they do not require much credibility. Funding also they do not require, they do not look for fundings of VC and all those kind of things. Wholesalers, small manufacturers, for them partnership firm is suitable. CAs, legal practitioners, medical practitioners, for them also partnership firm is fine. Now LLP also, CAs who are willing to limit the make sure that liability is limited, they can go for LLP, otherwise they can go for a normal partnership firm. Architects, tech service providers, professional firms with limited liability needs, or any firms for which they feel that the limited firm liability should be limited, then they should go for a minimum LLP kind of structure. And business not seeking funding, if you are not seeking for venture funding, then go for a LLP. If you are looking for a venture funding and all, then the private limited is the option with you. Next, tech startups, scalable product based businesses, then you should go for a if your business is a tech startup where you will look for funding very shortly, or if your business is scalable product based business is there, then again once your scale will grow, you will require investors, VCs and all that, then better to start from the private limited structure only, so that later on you need not to again change structures of. Okay, business targeting institutional or angel investments. Business targeting institutional or angel investments, if you are looking for a funding in near term, then better to go for a private limited at start only. Business wanting structured governance, branding and credibility. If you want the credibility in the market, then go for a private limited. If you want branding, make sure that our branding is there and all that. Private limited is good, can have a patent and all those things, and itself private limited itself commands credibility in the market. And if you want structured governance, so that the other people can come and be satisfied that okay, everything is managed well, so then go for a private limited kind of companies. Okay, best use cases we have explained. Now let's come to final comparative recommendations by business goals. Okay, let's discuss. So in this part we will tell if your business goals are like this, we will recommend you a structure, and also we will tell you why we are recommending that kind of structure. Start as solo and test idea. If you want to start, if you want to test an idea and you want there is no more people, only you are the person, then better to go for a sole proprietorship, so that you can easily test your product also at a lower cost. And once you find that if these things are working out, you can always have an option to move on to LLP or private limited kind of structures. So it's a quick to set up, no cost setup, and low risk. Risk is very low, no cost setup, because very less, there is no separate registration required. Any tax registration you will take and you can start your business. Family, retail or wholesale. If it is a family owned retail or wholesale shop, then go for a partnership firm. It's easy to manage and less compliances are there. No board meeting, nothing like that. Filing annual financial statements with ROC and all those things are not there. Even to register also, you don't have to go to any authority. Simply there should be a partnership deed, and that you can take a pen based on that and start a business. So that kind of a business, if family retail wholesale business is then go for a normal partnership firm. Now professional firms with the low risk. So professional firms like CS, your lawyers firms, then you can go for a LLP, because legal protection is there with flexibility. So flexibility is there, that you can add partners and all that option is there, as well as the liability is limited. Okay, so you should go for a LLP kind of. If your venture is fast growing startup with the investment, if your requirement is of investment and your venture is going at a very fast pace, then you should go for a private limited, because investors will be more comfortable investing in the private limited kind of companies. They can easily get the shares for which they will provide you the fundings, and again it's a scalable, like you can anytime when you need fundings and all, you can keep adding the people and keep issuing the shares, and the company will continue to grow without change in structure and all. Okay, so for that kind of case, investor friendly, scalable. Okay, next, mid-size firm not planning venture capital. If you are a mid-size firm and you do not need, you are not looking for a funding and all that, then you should go for an LLP. Safer than partnership, lower compliance than company. Okay. International expansion. If your business, you are looking for an overseas expansion also in India, domestic as well as overseas, then you should go for a private limited company, because credibility, again global credibility, because people here, when the audits are happening, so many filings will be done, the documents will be filed with the government, and anybody across the globe can download those documents by paying a small amount of fee to the government. So people will be easily able to access your data, and they can know what filings you are doing with the government departments. So it gives more credibility, because people are able to see the documents, read your documents. And structured government, and governance is also structured, because there will be levels, the directors, executive directors, so many compliances are there in private limited, so they have already defined that how do you have to govern the company. So structured governance is there. So in that kind of case, if your international expansion plan is there, then go for a private limited kind of company. Okay. Long term sustainability, LLP or private limited. So long term sustainability, if you are looking for a long term, then make sure that you go for a private LLP or private limited, because perpetual section is there, legal protection is also there. Perpetual, if you go for a normal partnership firm, partners, one of our partner dies and you are not able to reconstitute the firm, the business will die. Proprietorship also again based on that. So that's why if you're looking for a long term, then go for a perpetual. Member may come and go, but business will continue. As well as legal protection is there, no extra liability other than the committed amount. Okay. If you want to avoid personal liability, again you can go for these two structures. Shields your personal assets. Your personal assets will not be brought to make the payment of business liabilities. Okay. So this way we have concluded today our part 2 also. And here we have recommended also what business is having, what structure is having, what advantages, limitations and all, and best use cases also we have explained, as well as we have given you the comparative analysis also, recommendations, that best business goals, recommended structure, and why it is recommended also. Okay, hope you will find it helpful for your getting a better understanding of the things. Thank you so much. Please support us by subscribing our channel, and please give a like and thumbs up. Thank you so much. Let's see you in another video, the part 3 we are coming up. Okay, thank you. In that part 3 we will be discussing that what KYC documents are required and what information you should keep it ready before starting a process, so that it becomes handy. Otherwise, every time a document is requested, again you have to go back and work out a document and then give it to. So first only we are going to discuss that these are the documents. If you are choosing any one of the structure, what documents you should keep ready. Okay, thank you so much.